Welcome back to my lectures on translation exposure. Let us continue with the oldest method used for translation exposure. This method is called the current non-current method, and the name itself would help us actually implement this method, because here you're looking at an asset and you're asking yourself, is this asset current or is it non-current? Recall from finance and accounting that current means less than a year. And of course, the philosophy behind this is that we do our accounting statements yearly. So if, let's say, a loan is for less than a year, and we sell that loan, we say we are in money markets. But if that loan is for more than a year and we sell it, we would say we are in capital markets. So the current definition means that an asset is for less than a year, a loan for 2 months, and for example, cash in the account that would be used for paying the workers. And non-current means that this asset is long-term. So we ask ourselves in this method, is the asset current or non-current? The method started in USA and was used there until 1976. At that time, USA moved to a different method. This current non-current method is the method that is used today in Germany, for example. Under this method, the balance sheet of a foreign subsidiary is translated into the parent's home currency, looking at assets that are current, and current assets or short-term assets and current liabilities are all translated at the current exchange rate. For example, cash is translated at the exchange rate at the date of the financial statement. And of course, one may use a yearly exchange rate for that year. For example, the exchange rate of January 4 every year. And non-current assets and liabilities, such as long-term debt being a non-current liability, is translated at the rate prevailing at the time that asset or that liability was incurred. And that's the historical rate. So if we purchased the factory in 1978 in Japan, the exchange rate of Japanese yen against, let's say, euro for 1978 applies. Moving to the income statement, income statement is translated at the exchange rate for that reporting period, or at the actual rate on the date transactions were incurred. Using the actual date as exchange rate changes every day is quite a headache. So it's much more practical to take a yearly exchange rate. And normally, if we take exchange rate from a data provider for a year, or if we take exchange rate of a certain date, as I said before, January 4th every year, and we don't try to play a game by 1 year using January 4 and another year using August 22nd exchange rate, we are okay. The regulatory authorities would not complain about the exchange rate that is used as long as it's common and consistent. Depreciation and COGS. COGS stands for cost of goods sold, and this is the raw material cost, variable cost, and fixed variable cost only that goes into the production. These are translated at the same exchange rate that we use for them in the balance sheet. Depreciation is often historical, um, because the asset is a long-term or non-current asset, and those assets are depreciated. And Cost of goods sold, particularly if we buy a load of lumber this year and use it this year, we would translate at the exchange rate of this year. What is the philosophy behind this methodology? The focus here is that if we have a short-term asset, we have to buy and use this asset often, and therefore today's exchange rate, value of money today, affects how much we pay for this asset in a foreign land, in a foreign currency. Another way of putting this is to say current assets and liabilities are exposed to the exchange rates. And they are volatile. We pay often, and the value changes with the exchange rate. But fixed assets, fixed like a building, like a laptop, and we also call them real assets, assets you can touch, as opposed to financial assets, which are contracts on a piece of paper. Their value is not exposed to exchange rates. These are long-term assets, and normally, when the exchange rate of a country, for example, goes half price, the value of real assets, houses and buildings and machinery, in their money, the price becomes double, and it keeps its value in terms of a foreign currency. That is, real assets are not affected as much by inflation, and they keep up their value in times of currency crashes, which is the main concern philosophically underpinning these translation methods. We want to keep the values as honest and as real as possible. Similarly, long-term liabilities do not have to be repaid at the current exchange rate. They should not be subject to short-term fluctuations of current exchange rates. So that's the underlying philosophy of this method. Let us move to the next method. This method is called monetary and non-monetary method. As with current and non-current, the name of this method helps us a lot in remembering what to do. You ask yourself is if an asset is monetary, if it's financial, or if the asset is non-monetary, real asset. Is it a building or is it a loan? Financial assets, for example, a share of a stock, and financial liabilities, if we borrow money and use it as capital, are translated at the current exchange rate in effect at the time in the balance sheet, or the date of that balance sheet. Again, a yearly exchange rate or exchange rate that a data provider provides can be used instead of the exchange rate at the date of balance sheet. Non-financial or fixed assets are translated at historical exchange rate. So the value of the laptop is translated at the exchange rate of 2 years ago when we purchased the laptop in Japan. Income statement items are translated at the average exchange rate for the reporting period. This word average here can be also substituted with the exchange rate that the data provider provides, or exchange rate of a fixed date in the year. Non-monetary assets or liabilities, such as depreciation. Depreciation is for a real asset and we can touch it. Cost of goods sold, COGS. These are again variable cost of metal and lumber and other inputs into production. These are translated based on historical rates. under non-monetary and monetary method. All monetary assets are things like short-term financial assets, uh, short-term financial income. They are translated at the current exchange rate. Let's briefly look at the philosophy of this method. The rationale is that financial assets, such as stocks, bonds, um, debt, long-term debt, they are exposed to currency fluctuations. We could sympathize for this philosophy. We could understand this philosophy. We could sympathize with it, thinking about, for example, South American loan crisis. As the currency of the countries go half price, and their long-term debt in hard currency becomes affected and becomes a huge burden. Therefore, these monetary liabilities and monetary assets need to be considered separately from real assets, because monetary assets are subject to inflation fluctuations. Notice that the philosophy of monetary and non-monetary method is different from the philosophy of current and non-current method. And these philosophies are um, under rocks of arguments that regulatory agents had used for implementing different methodologies. Therefore, you should not take them as precisely accurate, and the fact that they conflict with each other should not bother you. Neither one of them is like a natural law. The value of non-monetary assets rises with local inflation. As I discussed before, a house may go double in price in a country where their currency have gone half price against hard currencies of the world, which under the assumption of purchasing power parity maintains the home currency value of assets despite exchange rate movements. This purchasing power parity is, of course, a loaded term. Most of us know it when they talk about citizens of a poor country making a ridiculously low amount of income, let's say 500 US dollars per year. Then we say, well, this 500 should be adjusted because it buys a lot more goods and services in that poor country. And we make it to, let's say, $4,000 to show its true value in terms of purchasing power. And obviously, this getting the 500 and making it to 4,000 is controversial, because the true value, the true purchasing power in each country is not known so precisely. So it makes our data imprecise. There are other ways that purchasing power parity is explained, and it's a whole lecture by itself. But here, this would allow us to build from scratch and understand it. We are saying that, look, if you got a house and money goes half price, your house will go double in local currency, and if you sell that house, it would buy you the same number of food items and consumption as it would have done in the past when the currency didn't go half price. Purchasing parity. Next, we move to temporal method. Some scholars do not consider temporal method as a different method. They say it's just monetary and non-monetary method with a slight difference. Some do. Under the temporal method, the difference with monetary and non-monetary method is how we treat inventory. We usually translate inventory at historical rate. However, temporal method allows us to translate inventory at current rates um, if we carry the inventory at market price or at replacement cost in our accounting. Of course, carrying at current exchange rate makes the calculations a bit more user friendly. So this method allows it for inventory only. The monetary non-monetary method does not allow us to translate inventory at current exchange rate. It has to always be translated at historical rate. So that is the crucial difference between these two. All right, let us move to some 2 points actually. One that we already discussed, that some scholars do not consider this temporal method as a separate method, and therefore say that we have three distinct methods for translation. The other point is something that I discussed at the beginning of these lectures. These three, or if you will, four methods have evolved over time because corporations have complained about how translation affects their bottom line, how it imposes extra risk on them. Both monetary and non-monetary, and this temporal method, which were methods that U.S. moved to in 1970s in order to make the situation better, have this problem that the reported translation losses or gains become basically something that affect net income or the income statement itself. To put it plainly, the firm shows losses and gains. It loses money because its subsidiary on paper have lost money after we translate their currency to our currency. A paper loss affects our profit. And of course, the firms see this as a problem. Not only the loss itself is a problem, the larger problem is the volatility. Volatility translates into risk, makes the profit of the firms more risky, and therefore it lowers their value. A riskier firm with the same profit has less value than a safe firm with the same profit. So government, by their translation method, makes a multinational company lose money. To address this large swings in quarterly earnings due to translation, U.S. government will move to its current method. And no pun intended, but the current method is also called the current translation method, the current rate method. This method is very easy to remember. Um, Everything is translated at the current exchange rate. Everything is translated at current exchange rate. Let me emphasize that. That means today's exchange rate is used to give you all the values on all accounting statements and make them from a foreign currency into home currency. There is always an exception to a rule, or at least to this rule, and that exception is that net worth or value of the firm, basically what we paid for our factory, it's always translated at the historical rate. So with this one exception for net worth, or another word for net worth is equity value, what we own, is translated at the historical rate. And to have a good understanding of this equity value, um, focus on the following simple-minded example. Your family has a house. The house can sell for 250,000 euros. You have 50,000 euros loan from the bank remaining on your house. They ask you how much equity do you have in your house. You say 250 price minus 50 goes to the bank because we owe them money. Our equity is 200,000. This very simple-minded example makes you understand equity wherever it comes up in an accounting statement. It's basically what we own, what the firm owns. That always is translated at the historical value. How much did we pay to acquire the factory in 1956 in their currency? We translate it to our currency. Everything else is translated at the current exchange uh, rate under the current method. Another simple-minded way is that this current rate is easy. We apply one rate to translate everything. It's user-friendly, and that's American way, a funny way of remembering it, remembering the American method. All assets and liabilities are translated at the current exchange rate on the balance sheet date. And of course, this could be the exchange rate of that year that data providers provide us, or exchange rate of a fixed day, closing day, well defined by our company and consistently used every year. Equity is translated at the historical rates. Income statement items are translated either at the rate on the date that the sale or purchase occurred, or a weighted average of exchange rates for the appropriate period. Again, this is legally there, but almost no one uses this weighted average exchange rate. We all go for an easy method that is workable and doesn't give us a huge paperwork. And that method is using the exchange rate that the data provider provides for that year, or using the closing exchange rate for January 2nd, for example, every year, and staying consistent with it. These matters, when they come to dispute, are matters that, for example, if it's for taxation, are often settled based on a negotiation. So if we have done it fairly and consistently, the tax authority may accept it or may not. And then there is a negotiation. Our firm may not accept it and go to court over this. And then again, a judge would look at the fairness of it. So some of these accounting methods using a weighted average or the exchange rate of date of January 4th depends on past cases, and depends on practice, what is done by most of the firms without difficulty. Now we come to the largest advantage of this current method. The all-current method does not give us losses or gains due to translation. So our income, the income of a multinational firm, is not affected. Their net income is not affected. Their profit is not affected if, for example, the currency of the country where they have a subsidiary in goes half price. Any losses is carried in a separate um, account, and it's reported in that account. Gains are also reported in that account. And until the multinational company sells this subsidiary, those losses or gains are not realized. Therefore, we are spared from that dreadful liability, not liability, volatility that imposes additional risk on the company and lowers its value. Translation gains and losses are not reported in the income statement. They are lumped together and listed as a separate equity account. So yes, in the balance sheet, we would lose value, owners would lose value, but our profits are not affected. This account is called a CTA. CTA stands short It's abbreviation for cumulative translation adjustment, and those words talk to you. Cumulative means we added up or subtracted gains and losses that came from translation every year, and this is an adjustment account that lowers or increases the owner's wealth or owner's equity in this multinational company, and it goes in the balance sheet. Only when an asset is sold, the realized gain moves from the CTA to the income statement, and of course, if we sell the company, this happens too. Under this method, corporations feel less pressure to hedge our profits. Our net income is not affected by translation, so we have less pressure to hedge this translation risk. Yes, translation affects our bottom line in the balance sheet, but usually that's not so critical when we go to raise capital, or the stock market pays a lot more attention to our profit than to our balance sheet values. Their translation exposure in order to prevent volatile quarterly earnings that the other methods of translation gives us. So we don't have to hedge this method. It gives us less volatility, and that's a great advantage of our current method. And of course, the other advantage is its ease. We can use it easily, and you would see that advantage at the exam time. Another terminology that goes together with our current method in US is this term functional currency. And of course, this functional currency is now a word that we have in accounting and finance, and is used in other countries too. To put it simply, if we have a factory in China and that factory uses raw materials in that local market and then sells its products in that market and internationally, then our functional currency should be Chinese renminbi or Chinese currency. However, if we have a subsidiary in China that serves as a factory and gives all its production to the parent, let's say over here in Germany, and the parent uses that to resell this product. So in the case that all our production is sent to the parent and we are a subsidiary in a foreign country, then the parent is allowed to use its own currency as the functional currency of the subsidiary. This prevents a lot of headache. Essentially, it makes translation something we don't have to do. We just use euro as the currency of a subsidiary in China that sends us all its output at a transfer price cost to the parent, and the parent uses this output, modifies it, and sells it, for example, in the European market. The functional currency is the primary operating currency of a subsidiary. The reporting currency is the currency of the parent's financial statement. Definition of two different currencies. And now we say that, look, this functional currency could equal the reporting currency or could be different from recording currency. The functional and reporting currency may be the same. If a foreign subsidiary is self-sufficient, buying material and selling its good in a local foreign currency, then it should designate the local currency as its functional currency, and then we have this translation um, methods and what you have learned in this chapter. If the foreign subsidiary buys material in parent's currency and sells all its output back to its parent, then the parent's currency will be both its functional and reporting currency, even though the subsidiary is located outside of the parent's home country. And in this case, um, essentially the whole translation lecture that you are getting here would not be used. You could forget this lecture. Of course, this case is there, otherwise I would be out of business, right? Uh, let's go back and emphasize inflation because it's at the heart of the problem with translation. Inflation historically had caused currency crashes. Of course, there are other causes too, but inflation had been a major cause. So, a country historically like Argentina with huge inflation had also seen huge devaluation of its currency. And then that brought huge headaches in terms of translating the value and income of subsidiaries of multinationals in Argentina into hard currency, dollar or euro or yen or something else. Depreciation, plant and equipment would all be understated if they were translated at the current rates, instead of historical rates in a hyperinflation environment. So this is a bit funny. No matter what the regulatory agencies do to make our job easier, little problems show their ugly head. And here is a problem with the current method. If we just use the current exchange rate to report the value of something that was purchased a few years back, for example, a computer system was purchased 10 years ago and now their money had gone half price and this thing is not fully depreciated. Um, 10 years is too long. Let's make that 2 years ago. Um, Anyways, when we translate at this half price currency value of today, suddenly this asset would be reported at half price because now the value of all these fixed assets have gone twice in their currency. Um, so we have a headache. The fix for this headache on the current method is rather easy. The current method uh, says, look, if you are in a country that has hyperinflation, we give you uh, a remedy. And hyperinflation is defined 3 or more years, uh, not more. Inflation being 100% or more in 3 years. So if you are in a country that cumulative inflation in 3 years is such that prices at least double, then you could use this remedy that the current method gives you and take care of distortion that appears in the value of fixed assets if you translate them at the current exchange rate. The provisions aim at requiring that the foreign subsidiary corrects the distortion that arises when depreciation at historical cost is translated into historical terms. By that correction, we simply mean that if prices are doubled, we are allowed to double the value of the asset after we translate it at the current exchange rate, which is half price. So essentially, it takes care of the problem. Obviously, this currency going half price is a little bit of an approximation because currencies don't move with inflation so precisely. But the method allows us to double the value. Let me pause the lecture here and we'll move to part 3.